Hello guys, and welcome back to another YouTube video here on my channel. This video is a video I wish I had when I first started out trading, and also a video I wish I had when I first started out trading ICT concepts. So today we're talking about true support and resistance in the market. These are levels I have on my chart every single day to see if we have a reaction off of these key levels, and if we do have a reaction off of these key levels, these are levels I want to take trades from or also take trades to. So let's get straight into the charts and let me show you what I mean by that. So for you guys that don't know, I trade only NQ and nothing else. So this video is very helpful for people, especially that trade NQ, but also ES or YM. All of those are important. They're all correlated. So yes, I think a lot of people already know that I'm trading NQ, but for those that don't know, I trade NQ, Nasdaq, and that's why we have the Nasdaq here right now. So I have a clean chart here because I really want to show you what I mean with these key levels and how to draw them in the chart, because I always have my templates here in the top, and in the first template I always have the 1 minute chart with exactly these levels drawn out. So first thing, we talk about a very broad and simple key level that I think most people still miss. So for that, we're going on the weekly chart. So in this instance, for example, when we open up next Monday, I would first of all draw out last week's high and last week's low. So let's do that actually. I always have my key levels in the same colors so that I know when I'm on the lower time frame what the key levels are. So you pick and choose your colors. I have my colors already. So, and all the levels I draw out today are not only key levels where I want to take trades from. You can take trades from there. That's high probability. You can take partials or even take completely, like your full profits there. So these are the key levels I would draw out. So yeah, this one as well. So here we have liquidity that is not traded to yet. So the next thing we do is drop down to the 1 day and do the same on the 1 day. But what's important to note here is that I always only draw out the highs and lows of the previous 3 days. Always the 3 last days. It doesn't matter if we already took them out or not. Still draw them in your charts because they are really strong support and resistance key levels, which the market respects heavily. Then the next thing we do is we drop down to the 1 minute time frame. And what we are going to do here, we are going to go to 6 p.m. Yeah, that's right here. And for those that don't know, I always have my chart on New York time, so I never see my local time down there. I always see the New York time, and this is so important, especially if you draw out key levels, because the market works in New York time. So the next thing we're drawing out are new day opening gaps. And I always was so confused what those are and how to draw them out. So I'm telling you right now, and I always have 5 of them on my chart. So the past 5 new day opening gaps. And for that, it's important to know why we draw them out, because every single day when you go on the daily time frame, let's go on the daily time frame again, the open of those daily candles are not at midnight, but at 6 p.m. So that's important to know, and this is why we draw them out, because they are inefficiencies of every single day of the open of a new daily candle. So let's go back to the 1 minute and let's go to 6 p.m. This is the previous day, this is the new day, and we closed the previous day here on that candle at 4:59 and we open up at 6 p.m. So we're drawing that here. I always extend the lines that I have them throughout the whole chart. And for the people who are completely new, you can use the magnet, so you don't have to guess where the open or the close of a candle is, but it leads you directly to it. So yeah, and you can also see the exact levels of every high, of every open and close of the candle. When we go on the candle, you can see it right on the top here. Like the open is 25,033.50 and the close is 25,028. And we're going to do that now on every single opening, on every single daily open. And when the new day opening gap is very big, then I always like to draw the middle line as well. So as you guys saw, I skipped one day, and that's because of the next key level we're going to draw out, and it's the new week opening gaps. So now we have drawn out the new day opening gaps, but there is a difference between new day opening gaps and new week opening gaps. It's pretty simple, but it was very confusing for me in the beginning. So as you can see, what we now did before was we draw the close of a previous day on the 1 minute time frame and the open of a new day on the 1 minute time frame. But it's the same with the weekly candle as well. The week ends on Friday at 4:59 p.m. and opens at Sunday on 6 p.m. So this is the gap of a new week. Yeah, we do the same here as well. And I also have 5 of them on my charts. The last 5 new week opening gaps. So we have, first of all, the close here and the open of the new candle here. And I have them in a different color. And with them, I always have the middle line because they're pretty much every time pretty big. But what I also do is I draw out the opening of the new week because this is a very, very, very highly respected key level in the market. So I always have it here as well. So what we're going to do is we don't scroll, but we jump right to the date. So as you can see right here, this is the last available candle on the 1 minute time frame. So we're actually switching to the 3 minute time frame so we can have more data. So now we're back on the 1 minute time frame. We have determined the weekly highs and lows. We haven't swept yet. We have determined previous daily high and low of the 3 last days. We have determined 5 of the past new day opening gaps and 5 of the past new week opening gaps. And this is how the chart looks like now. So the last key level we're going to draw is the first presented fair value gaps. And trust me, these are crazy respected as well. What we're going to do is we draw out 3 of them, 3 of the past previous first presented fair value gaps. So what we're going to do now is we switch from electronic trading hours to regular trading hours. So as you guys know, the New York Stock Exchange opens up at 9:30 every single day from Monday until Friday, and it closes at 4:14. So we have the close and then we have the open. And one key level, which I'm going to show you also, is opening range gaps, but I don't have them actively on my chart when I'm trading, but I still have the levels in my mind or a different layout where I have the levels on the chart, so I see where the midpoint is and the high and the low. So this is what we call the opening range gap. The close on the regular trading hours of the previous day. So we would have this right there and the open of 9:30. So this would be the opening range gap. And to give you one extra, when you determine your daily bias and you go on the regular trading hour chart and you see a opening range gap not completely filled, this is a strong drawn liquidity for the day, or at least for the days to come. So as you can see right here, when we open up again on Monday, we know that the opening range gap from Friday is not completely filled because we closed on Thursday right here and we opened up on Friday right here on the regular trading hour chart, and we only filled it until here. So this portion you can also mark out if you want to. I have a different layout where I mark them out. So you know, okay, this is an inefficiency in the market where the market is likely to draw to. But now let's get actually to the first presented fair value gaps like I told you. So it's simple. The first presented fair value gap is the fair value gap that presents itself first when we open up at the regular trading hours. So important to note that you can't take the first presented fair value gap at 9:30 because there is no previous candle. So if this candle would have formed a fair value gap on the electronic trading hours, then it's not the first presented fair value gap. So in this case, the first presented fair value gap would be at 9:32. So we can mark that out with a box as well. And I always have them in yellow. And we will do this with the previous 3 days. So here, Friday, Thursday, and Wednesday. And this is what I mean with a fair value gap that forms at 9:30. So when we go to the electronic trading hours chart, let's do that for a second. And we go to Wednesday where we just were. As you can see right here, we open up at 9:30, and this is not the first presented fair value gap because the 9:29 candle is not there on the regular trading hours chart. So the first presented fair value gap here would be this one. So, and now we actually have a pretty example right here. As I told you, these levels on the chart, they really act as support and resistance. First percentage fair value gap, strong support here afterwards, and then we just went off to the upside. So now we have all the key levels on the chart, and let's recap. So that's it. These are the key levels. Let's make that actually bigger. And now let's explore and see if the market really respects them. So let's go back to Wednesday. As you can see, if you would have traded the, let's say, the London session, which starts at 2:30 in the morning, then you would have gotten here a beautiful support at a new day opening. Then again, we have support at the middle point of a new week opening gap here as well to the tick. Here we find support again as well at the middle point of a new week opening gap. And then we open up at 9:30 and we spool to the upside. Here again, we find support, which I already showed you at the first percentage FVG. Then we open up again the next day. Here again, to the freaking tick, support at the previous day, first percentage fair value gap. And then we just spool to the upside. It's crazy. This is in the Asia session. Then we find resistance here at the new day opening gap. Again, then we drop down. And this is also one thing I want to emphasize. When you see this right here, these are two new week opening gaps. As you normally would say, okay, you want to see support there when we drop down. But it's either we find support or resistance, or we ignore it completely. And when we ignore one of those key levels, like we do right here, then the market is showing you its hand that we are very, very heavy, that we're very, very weak, and that we're likely to drop even more. So yeah, and it's the same for the upside as well. When we don't find resistance at these key levels, then the market is showing you its hand that it's very strong and very likely to go even higher. So here again, we dropped and then we retraced to the upside, but here beautifully we retraced exactly to the new week opening gap. And from there, we wicked just the high of it and then dropped lower. And I think, yeah, I traded this move down on Wednesday. So yeah, at the key levels to take a trade, it's very, very high probability. And so what you can see here, this is the very big difference to what we saw right there. Here we just dropped right through it, but here the market really found resistance here at the key level, at the new week opening gap. So then we see here again at new day opening gap, support, support, support. So here beautiful at the midpoint of the new week opening gap, dropped lower and went back higher. So here again we see resistance at the key level, at the high of the new week opening gap. Here as well, you see that? It's so beautiful. And I could go on and on. It's every single day the same. You have strong, strong support and resistance at these key levels. So if you see two or even more key levels stacked together, then it's even a stronger key level like we have right there. And from there, we just spooled to the upside on Friday. And guess what? Where we went to? Exactly, to a key level. Right here and right here. Again, support. It's so, like, this is so fun to watch, guys. If we're being honest, it is so beautiful. So yeah, I really hope this helps you. It is really, really, really helpful to have them on the charts because they are being respected so much, even to the tick most of the time. Like we see here, 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 and here. So have them on your charts, these key levels, and I know you will thank me later. So I'll see you in the next video, and I wish you a very successful next trading week. Bye bye!